Good morning. Numerous significant events have unfolded across the globe, and today we'll delve into some of the most impactful developments shaping our world. Stay with us as we unpack these complex issues and provide in-depth analysis. We will present our conclusions at the end of this video. Chinese tariffs on U.S. goods are poised for a dramatic increase, jumping from the current 34% to a staggering 84%, effective tomorrow. This sharp escalation marks a significant moment in the ongoing economic tensions between the two superpowers. Beijing's Commerce Ministry has reacted strongly, accusing the Trump administration of engaging in blackmail tactics. They characterize the U.S. tariffs as a typical example of unilateral bullying practices, highlighting the deep-seated disagreement and mistrust coloring the relationship. This isn't merely a diplomatic spat or an ideological clash anymore. The battle for global supremacy between the United States and China is playing out in tangible ways across the international stage. We are witnessing its real-time effects on financial markets, critical shipping routes, and the very fabric of economic policies worldwide. The repercussions of this escalating conflict are far-reaching, sending ripples from the financial heart of Wall Street to the quiet corners of rural towns. The impact is felt across diverse sectors, from cutting-edge technology companies to foundational agricultural enterprises. Everyone is caught in the cross-currents of this high-stakes economic confrontation. At the epicenter of this intense conflict stand two formidable leaders, Donald Trump and Xi Jinping. Each commands immense power and is employing every available tool to reshape the global order according to their nation's strategic advantages. Their actions, driven by complex geopolitical calculations and domestic pressures, are fundamentally altering the landscape of international trade and relations. The strategies they deploy, whether through tariffs, sanctions, or diplomatic maneuvering, have profound consequences that extend far beyond their respective borders, affecting economies and populations globally. The interplay between these two leaders continues to define the trajectory of this critical period in international affairs. Please consider subscribing to our channel and hitting the like button. Your support is incredibly important for helping us grow and continue bringing you this content. Also, let us know in the comments where you're watching from. We love hearing from our global audience. The economic environment is becoming increasingly tense, causing financial markets to swing wildly. Uncertainty and volatility have become the new standard, reflecting the precarious nature of the current global situation. A senior executive from BlackRock, the world's largest asset manager overseeing more than $11 trillion in assets, recently described this moment as deeply unstable. This assessment underscores the gravity of the situation, coming from a major player with a significant stake in global financial health. The executive pointed out that the most significant unknown factor is the extent to which tariffs will be implemented and how long these measures will remain in place. This ambiguity creates a challenging environment for businesses and investors trying to navigate the turbulent economic waters. The lack of clarity regarding future trade policies fuels market nervousness and hampers long-term planning, contributing to the overall sense of fragility in the global economy. Please make sure to watch this video until the very end, as we'll be summarizing the key takeaways and offering our concluding thoughts. Markets might occasionally display brief signs of optimism, tilting into positive territory on certain days, giving a fleeting impression of recovery. However, the underlying sentiment remains overwhelmingly fragile. This inherent weakness was shaken once again today when China's finance ministry announced a significant escalation. It would raise tariffs on all U.S. goods from 34% to an astounding 84%. This move represents a clear and heavy blow to any American business attempting to sell its products into one of the world's largest and most lucrative consumer markets. The decision, made as a direct retaliation to President Trump's earlier increase in tariffs on Chinese imports, which now stand at a minimum of 104%, has sent yet another powerful shockwave reverberating through global financial markets. The tit-for-tat nature of these tariff hikes underscores the escalating tensions and the potential for further economic disruption on a massive scale. The immediate reaction in the financial world was palpable. U.S. stock index futures experienced a sharp decline, reflecting investor anxiety about the escalating trade dispute and its potential impact on corporate profits and economic growth. Similarly, Germany's DAX index also fell steeply, highlighting the interconnectedness of the global economy. This drop serves as a stark reminder that economic shocks in one major region can quickly spread across borders, affecting markets worldwide. The sensitivity of these markets to headline shifts underscores the fragile state of global economic confidence. This tariff increase isn't just an abstract number on a government ledger. It represents a massive shift with serious, real-world consequences. Every American company involved in business activities within China, spanning industries from consumer goods manufacturing to heavy industrial production, is now confronting a significantly tougher and more uncertain economic landscape, forcing difficult decisions about future operations and investments. The newly imposed tariffs will inevitably increase operational costs for American businesses exporting to China, making their products less competitive. Furthermore, these tariffs limit potential sales growth within the vast Chinese market and are highly likely to result in lower profit margins for affected companies. This squeeze on profitability could lead to reduced investment, potential job cuts, and a slowdown in innovation. Adding another layer to the conflict, Beijing has confirmed its intention to take the Trump administration to the World Trade Organization, seeking international arbitration over the tariff disputes. Alongside this formal challenge, Chinese officials have subtly hinted that further retaliatory measures could be forthcoming, potentially expanding the scope of the conflict beyond simple tariffs. There's speculation about leveraging non-tariff barriers or other regulatory hurdles. We often forget, amidst the economic data and political posturing, that leaders like Chinese President Xi Jinping, while not subject to democratic elections in the Western sense, are deeply concerned about their legitimacy and historical legacy. President Trump's actions have arguably put Xi in a difficult position, forcing a response to maintain credibility both domestically and internationally. As commentators have noted, China is now girding for a prolonged fight, signaling a commitment to withstand the pressure and push back against perceived U.S. aggression. What's more, China has recently added 6 U.S. entities to its unreliable entity list, and another 12 to its export control list. These actions further escalate the situation, creating new obstacles for American companies operating in or trading with China. While these administrative measures might sound bureaucratic on the surface, they carry serious practical implications. Being placed on these lists means companies can face significant restrictions or even be entirely banned from engaging in trade with Chinese firms. This typically targets businesses involved in trade related to sensitive areas, such as Taiwan, Hong Kong, or technologies deemed politically or strategically contentious by Beijing. In some instances, individuals connected to these listed companies could also face personal sanctions imposed by the Chinese government. This multi-pronged approach demonstrates China's willingness to use various tools beyond traditional tariffs to exert pressure and retaliate against U.S. actions. China understands it cannot match the United States tariff for tariff, simply because the volume of Chinese goods flowing to the U.S. far exceeds American exports to China. However, Beijing possesses other levers it can pull to exert economic pressure. One prominent example is agriculture, a sector that was hit hard during previous rounds of tariff exchanges. If the Chinese government decides to target U.S. agricultural products again, a possibility hinted at by state media, it would directly impact President Trump's political base in rural America. Such a move would not only inflict economic pain, but also reinforce the perception that this trade war is deeply personal and politically motivated, extending beyond purely economic considerations. It highlights the strategic calculation involved, where trade measures are wielded not just for economic gain, but also as tools of political influence and leverage in the broader geopolitical contest. Simultaneously, China is attempting to transform this crisis into an opportunity for strategic realignment. In a recent meeting, President Xi Jinping stated that China would actively work to expand trade relationships with its neighboring countries, particularly focusing on Southeast Asia. This strategic pivot includes nations like Laos, Cambodia, and Vietnam. These countries, often caught in the crossfire of U.S. tariffs themselves, have experienced rising costs and reduced access to the American market. Consequently, China's outreach, offering alternative trade partnerships and market access, becomes significantly more attractive to them. By strengthening economic ties within the region, China aims to cushion the impact of reduced trade with the United States. More strategically, this move seeks to gradually reshape regional supply chains, making them less reliant on Western markets and potentially consolidating China's economic influence across Asia. This regional focus is part of a broader strategy to build resilience and counter U.S. pressure. In this complex geopolitical landscape, China is also carefully managing its international image. By presenting itself as a steadfast defender of multilateralism and the established international trade rules, Beijing attempts to contrast its approach with what it portrays as Washington's unpredictability and unilateral actions. This narrative resonates particularly well with developing nations that feel squeezed or marginalized by U.S. protectionist policies. They see China as offering a more stable, rules-based alternative for trade and investment. This diplomatic positioning aims to garner international support and isolate the U.S., framing the trade conflict not just as a bilateral dispute, but as a defense of the global trading system against disruptive American policies. Whether this portrayal is entirely accurate is debatable, but it serves China's strategic goal of enhancing its global standing while navigating the immediate pressures of the trade war. The effectiveness of this strategy hinges on its ability to maintain consistent messaging and follow through with tangible economic benefits for its regional partners. All of these maneuvers are happening within an economic environment already fraught with uncertainty. Global companies that depend on intricate, far-reaching supply chains are feeling the heat intensely. Consider the Boeing 737 as a prime example. Each aircraft is a complex assembly of roughly 2,000 parts sourced from 700 different suppliers spread across the globe. The wings originate from Japan, the fuselage is constructed in Italy, and some doors are manufactured in Canada, while the engines are supplied by Britain's Rolls-Royce. Attempting to reshore, or bring back, all of this production to the U.S., as President Trump has suggested, is a monumental task. It would inevitably take years to establish the necessary infrastructure and expertise, and the associated costs would run into the billions, disrupting established efficiencies and potentially raising prices further. This example illustrates the deep integration of modern manufacturing and the profound challenges involved in disentangling these complex global networks. In the meantime, higher tariffs simply increase the cost of doing business across the board. Companies like Ryanair, which has dozens of Boeing aircraft currently on order, could now face substantial additional import fees, potentially totaling over £400 million. These increased costs are unlikely to be absorbed solely by the airlines. They will almost certainly be passed on to consumers in the form of higher air travel prices. And the impact isn't confined to the aviation industry. The ripple effects touch nearly everything consumers buy, from smartphones and televisions to cars and clothing. These are global industries built upon decades of integrated trade networks. Unraveling these complex systems overnight, as some rhetoric might imply, is quite simply impractical and carries immense economic consequences. The intricate web of global production means that tariffs imposed in one area can trigger cost increases and disruptions far down the line, ultimately affecting the wallets of ordinary people worldwide. As uncertainty spreads like wildfire, companies are hitting the pause button on major decisions. Investments are being shelved, new projects are delayed, and expansion plans are put on hold. People are hesitant to switch jobs in an unstable market. Factories are delaying expansions, and hiring has slowed considerably compared to previous periods. This economic hesitancy is a direct consequence of the trade conflict's unpredictability. According to analysts at BlackRock and other financial observers, this widespread caution is the real underlying threat. Economies thrive on momentum and confidence. Without them, stagnation begins to set in, which can lead to longer-term economic damage far exceeding the immediate impacts captured in headline figures. The reluctance of businesses to invest and consumers to spend creates a cycle of slowed growth that can be difficult to break, potentially ushering in a period of protracted economic malaise if the uncertainty persists. Behind all the economic figures and political maneuvering lies a deeper, more fundamental question. Is the global economic system, as we've known it for decades, being dismantled, or is it merely being restructured into something new? Since 1944, the world has largely operated under the Bretton Woods system. an order anchored by the dominance of the US dollar and characterized by relatively open global trade. This framework facilitated decades of globalization and economic integration. However, under President Trump's leadership, there has been a clear and deliberate move away from this established framework. His administration has prioritized bilateral deals and challenged long-standing multilateral agreements. In fact, Trump has even publicly suggested the idea of weakening the US dollar to boost American exports, a radical departure from decades of US policy favoring a strong dollar. This shift signals a potential move towards a more fragmented, protectionist global economic landscape. This departure from the post-war consensus is viewed differently depending on the perspective. According to former officials who served during Trump's first term, like Nazak Nikaktar, the United States is simply responding assertively to years of what they perceive as unfair trade practices by China. They argue that these practices, including state subsidies, intellectual property theft, and restricted market access, have systematically undermined American workers and industries, enabling the rise of a powerful economic competitor. From this viewpoint, the tariffs are a necessary, albeit disruptive, corrective measure. Nikaktar contends that the status quo with China had become untenable, and that this hardline approach, while long overdue, is essential for resetting the terms of engagement. The underlying belief is that only significant pressure will compel China to alter its economic behavior and adhere to fairer trade principles. This perspective frames the conflict as a defense of American economic interests against predatory practices. The view from Beijing, however, presents a starkly different narrative. China's leadership sees the tariffs not as a corrective measure, but as part of a larger, deliberate campaign by the United States to suppress its economic development and maintain American global dominance. They interpret the actions as an attempt to contain China's rise and prevent it from challenging the existing international hierarchy. In both Washington and Beijing, the logic driving the conflict is rooted less in pure economics and more in the complex dynamics of power politics and national interest. As the rhetoric on both sides hardens and policies continue to take shape, it becomes increasingly clear that the trade war is no longer just a dispute over tariffs and trade balances. It has evolved into a fundamental test of national resolve and a battle over competing visions for the future global order. Both sides believe they have too much at stake to back down, perceiving significant gains to be made by standing firm. In this highly charged environment, compromise becomes not only difficult, but also politically perilous. Leaders on both sides face domestic pressure to appear strong and unyielding. This dynamic makes finding common ground exceedingly challenging, even if backroom diplomacy continues privately. Behind every tariff announcement, every market fluctuation, and every official press conference, the real-world consequences ripple outwards, affecting families, workers, and businesses globally. People are trying to navigate a world that feels increasingly uncertain and unstable. In communities across America, like those in Virginia, the Midwest, or the manufacturing belt, there's growing anxiety. Many initially supported President Trump, hoping his aggressive stance would revitalize American industry, protect jobs, and force countries like China to engage in fairer trade. However, the immediate results have often been rising costs, market volatility, and a pervasive sense of economic fragility, leading some to question the long-term strategy. Take the examples of ordinary Americans caught in the middle. Gabriel, a nurse and mother, finds herself taking on extra shifts just to cover the rising costs of essentials, particularly baby goods and household items, many of which are imported and now subject to tariffs. Jim, a construction worker, sees the price of raw materials like timber and steel climbing dramatically, making projects more expensive and harder to complete on time, impacting both his work and his customers. While he might still believe in the president's overall plan, the immediate price hikes are undeniable. These personal stories reflect the broader economic indicators: stock markets reacting sharply, pension funds taking hits, investor confidence eroding, and businesses becoming cautious. Manufacturers reliant on imported components face the daunting task of rethinking entire supply chains, often finding no readily available domestic alternatives at comparable quality or cost. This complex reality underscores the far-reaching impact of the trade conflict. On the American side, The rationale for pressing forward with high tariffs remains anchored in the belief that China's economic practices will not change without facing tangible consequences. President Trump and his trade advisors have repeatedly argued that previous approaches, from WTO membership facilitation to bilateral dialogues, have failed to yield lasting results. Their argument posits that only the shock therapy of tariffs can force China to undertake the necessary structural reforms, particularly concerning state subsidies, intellectual property protection, and market access. However, critics worry that this strategy lacks a clear endpoint and a well-defined plan for de-escalation. Congressional hearings have revealed bipartisan unease, with lawmakers questioning the administration's approach and its potential long-term fallout. Some fear the White House has opened Pandora's box without fully considering the repercussions, while others worry the conflict could spiral out of control, potentially leading to wider confrontations, even if military conflict seems unlikely. From the perspective of many policy experts in the national security community, the pre-existing status quo with China had indeed become unsustainable. For years, successive American administrations attempted negotiations, offered market access, facilitated China's entry into the WTO, and encouraged foreign direct investment, hoping to integrate China into the global system as a responsible stakeholder. Critics argue, however, that China continued to subsidize its industries, engage in market manipulation, restrict access to its own economy, undermine American workers, and steal intellectual property. Nick Akhtar and others argue that President Trump's stance is a direct, necessary response to these long-standing issues, and that China should not be surprised by the pushback. In her view, the U.S. is no longer willing to be complicit in its own economic erosion, making a painful reset necessary. This perspective frames the tariffs not just as economic policy, but as a crucial strategy to protect national security by limiting technology transfers and reducing dependency on Chinese manufacturing, ensuring American industries and military are not vulnerable to a nation viewed as both a rival and a potential threat. The trade war was ostensibly intended to level the playing field, but currently, many Americans feel they are the ones bearing the cost. If prices continue their upward climb, job security remains uncertain, and investment continues to contract, the existing frustration is likely to intensify. As the global economy holds its breath, the next series of moves from both Washington and Beijing will be scrutinized intensely, not just by policymakers and analysts, but by every household, business, and market participant already feeling the impact of this unprecedented standoff. The question looming large is not just what happens next, but how long this period of instability will last, and what kind of global economic landscape will emerge when the dust finally settles. The answers remain profoundly uncertain, shaping the future for everyone involved. Conclusions. The escalating trade conflict between the United States and China is far more than a simple dispute over tariffs. It represents a fundamental clash of economic models, geopolitical ambitions, and national narratives. While initiated under the premise of correcting trade imbalances and unfair practices, the conflict has rapidly evolved, driven by deeper concerns about national security, technological supremacy, and the future shape of the global order. The immediate consequences are being felt worldwide: increased market volatility, rising costs for consumers and businesses, disruptions to complex global supply chains, and a pervasive sense of economic uncertainty that dampens investment and growth. Both nations are employing a range of tools, from tariffs and export controls to strategic regional partnerships and administrative lists, indicating a multifaceted struggle with long-term implications. From the U.S. perspective, particularly within the former Trump administration and its supporters, the tariffs are seen as a necessary if painful measure to force structural changes in China's economy and counteract practices perceived as detrimental to American interests. However, critics, including some allies and domestic voices, question the lack of a clear strategy, the potential for unintended consequences, and the risk of isolating the U.S. on the global stage. China, meanwhile, views the conflict through the lens of national sovereignty and resistance against perceived American attempts to contain its rise. While facing economic pressure, Beijing is strategically pivoting towards regional partnerships and emphasizing domestic self-reliance, potentially accelerating its long-term goals, even amidst short-term disruptions. The conflict is also being framed domestically and internationally as a defense of multilateralism against American unilateralism. Ultimately, this standoff highlights the deep interconnectedness of the global economy and the profound challenges of navigating a transition away from the established post-World War II economic order. The lack of trust and communication, coupled with strong domestic political pressures on both sides, makes compromise difficult and raises the stakes considerably. While the long-term outcome remains uncertain, the current trajectory points towards a potentially more fragmented global economic system, increased costs, and persistent instability that affects not just the two superpowers, but nations, businesses, and individuals across the globe. The path forward requires careful navigation, as the decisions made today will shape the international landscape for decades to come.